Thank you very much, Mr. Mott. So my first question is it your view that the serviceability buffer has disproportionately impacted prospective first home buyers?
Yes, to some extent it is. If you're an upgrader who's already benefited from house price inflation over a number of years, excuse me again, my computer is dropping out of me here. If you are suffering from, benefiting from ongoing house price inflation, you haven't needed to borrow as much. And also as you're further into your life, your income's generally higher. So it is the first home buyers who are being impacted by this more disproportionately and who are being hit by the reduction in borrowing capacity. There are also going to be some upgraders in particular and some investors who are buying multiple investment properties who are going to be impacted by this, but it's not as significant to their lifestyle. It's the first home buyers in particular who are really struggling to get into the housing market. The Commonwealth Bank of Australia put some great numbers out in their presentation. And it shows from about 2016-17, the borrowing capacity for a lot of younger people is down by about 40%. Now, if we go back to that time, it was probably a bit extreme, and we know that there has been some tightening in and necessary tightening, especially around making sure applications are accurate. But to your question, yes, this has disproportionately impacted younger first-home buyers.
Because they have lower levels of assets.
Yeah, exactly. If you're an upgrader, in most parts of Australia, house prices have been rising for a long time. So you have benefited from an increase in the equity of your house. So usually when you're upgrading, you're not borrowing as much, or you've got a higher income, but you're a lower deposit as well. So you're not being as impacted by the serviceability buffer as a young person trying to get in the housing market. And also it's disproportionate in where you live. If you're in Sydney, if you're on the Gold Coast or southeast Queensland generally, in Melbourne, you're going to be more disproportionately impacted just because house prices is a lot larger multiple of income.
Okay, and so the arbitrary nature of this 3% buffer, though, has also created, in some cases, what are known as mortgage prisons. Some people have suggested that. Do you have a view on that?
Yeah, definitely that was the case. So you've got to remember why that 3% buffer was introduced by APRA. So previously APRA had a serviceability buffer. From memory, it was over 2% with a floor of around 7 was the previous number. As interest rates went down towards 0.1%, and mortgage rates were being written less than 2%, about 1.9 was as low as mortgage rates got. You can understand APRA pushing that buffer up. As rates have risen, the buffer has become disproportionate, so it has become a burden for a lot of people.
And APRA is just doing its job, I think you'd have to argue here, because their mandate has been financial stability and to avoid risk at all costs, effectively. But do you think that the balance is right here between balancing risk against other objectives that we think would be important as a society, like first home ownership?
Look, when you look at prudential stability, it is paramount. Like the regulator, and we have seen around the world, when you have a system which is not well enough capitalised, or if there's financial stability concerns, look at the global financial crisis, or even look back 18 months ago when you saw Silicon Valley Bank collapse in the US. It is there. So we have seen this swing. And as I talked about in my opening remarks, we've seen a number of moves. Basel III, we've seen macro-prudential changes, we've seen the introduction of the BEAR and the FAR regimes, Royal Commissions. There's been a number of things that have come through. What we're talking about is the pendulum swung a long way. And at least for certain first home buyers, it probably needs to swing back a little bit to help them in there, because yes, financial stability is paramount, but the ability for young people to actually enter the housing market is more of an equity perspective. And in the proposals we're talking about, we're just talking about a rebalancing. We're not talking about reducing the financial stability of the system materially. We're just saying that we just need to help young people back into the housing market. And I think that's in the interest of all young Australians, and to be brutally honest, it's the interest of all Australians, even if you do already own your home. You know, we'd all like to see young Australians enter the housing market and, to be honest, see the opportunities that previous generations have experienced.
Okay, so I want to go to your model now. So you're suggesting that if these tweaks were made, that there could be an additional 50,000 additional first home buyers, providing that supply was provided as well. So are you arguing that this would be the case if there was a rebalancing of the capital risk weighting, not necessarily a overall change, but a rebalancing of that risk weighting within the banking sector?
Yeah, look, it's very difficult to model that number because, again, the first point you said was that we have to have those houses available for people to move into.
Yeah.
If there's no houses, it's always going to be a challenge. So, as you mentioned, supply is paramount. Supply is very, very important here. But let's go to the presumption that we are going to build more houses, and I think all sides of Parliament would agree that that's essential. What we're looking at here is that there is pent-up demand for first-home buyers who, at the moment, can't get into the housing market because, number one, the serviceability buffer is making it very difficult for them to pass that test. But secondly, the proposal that we're talking about reducing the risk weighting, and we're talking about a modest rebalancing for first-home buyers offset by an increase for upgraders and for investors, just gives them a bit of an advantage. Now, what that actually means is, from a bank's perspective, a risk weighting says that these risks, these assets are slightly lower risk, and there's a cross-subsidisation here.
Yeah.
So therefore, the bank can hold less capital against it. And banking is very, very efficient. And we know that Matt Comyn came out and said, the CEO of Commonwealth Bank, the banks are writing mortgages below their cost of capital. Now it's around their cost of capital. Whenever you reduce the capital, money will flow there and people will lend more aggressively to that area. And you'll see the returns on that come down. Now, that's great economic talk. What do I actually mean? Interest rates fall. Yeah. So you'll see a reduction in interest rates because the banks compete that away, and first-home buyers will see that benefit flow through to them. Now, the opposite happened a couple of years ago when APRA increased the risk weighting on investors. Now, how did the banks react? They instantly pushed up interest rates for investors versus owner-occupiers. The same will happen because banking is a very, very efficient industry, and you'll see capital flow to first-home buyers. And on our modelling, you'll see a reduction of about 0.29% interest rates to first-home buyers who buy to build or buy off the plan. Now, that would save over $37,000 over the life of the loan for a first-home buyer. It's a large amount of money that can help just by modestly reweighting the risk weights. And again, reweighting, I'm not talking about financial stability. It can really help young Australians.
So I just want to be clear about what you're recommending here to the committee. So you're recommending a lower risk weighting for first home buyers and an even lower one for first home buyers who build new or buy for plan. And then you're recommending a lower buffer that goes hand in hand with those lower risk weightings. That's what you're recommending in a technical sense.
To some extent. So I'll go a little bit further. So we would assume that you have the risk weighting for the mortgage book is around 25%, and that was recommended by the Murray Financial System Inquiry in 2014. Now, what we're saying is if we reduce owner-occupiers, and even more for owner-occupiers who buy new properties or build their own house or home, and you slightly increased upgraders and investors, so the weighting still stays consistent, that would really help young people. Now, if we also help them on the serviceability buffer, it enables them to enter. So the buffer is a one-off test. Once you can pass that test and they say you can borrow X amount of dollars, well, the buffer's no longer that relevant, is it? It's about can you pay the mortgage off through your life. So by doing these two measures, and the third one will impact, which is the changing and eliminating the HECS and the HELP, that really helps young Australians who've invested in their future by going to university or any tertiary course where you've borrowed money to do that. this could really, really help young Australians. And, as we talked about, it's very difficult to model this because we're talking about multiple policy changes and we have to assume there's enough houses there. But you look today, the number of first home buyers loans that have been lent out was about 115,000. If we go back to previous peaks in 2021, it was about 162,000 first home buyers entering the property market. And in 2009, it was 173. So we could be back at those levels. And we would assume that there is the demand there. The fact that we're all being asked questions by first home buyers, can you help me enter the market? What can be done about it? I actually think, and it is an estimate, not a modelled number, that you could see between 30 and 50,000 new first home buyers entering the housing market per annum, at least for a few years. Now, again, that's houses. Often that's a couple. So we'll be talking in that number, maybe there's about 1.6 people on average per loan. That could be up to 80,000 people entering the housing market, which is a small tweak, could be really beneficial to the economy and to society.
Just finally from me then, so if we went down this path of having a graduated system for first home owners or first home buyers under the risk weighting system, what would be, do you think, the response from banks? Do you think banks would then go and offer first home loan products? What do you think would happen?
Yeah, I definitely think that would happen. So just as at the moment you've got owner-occupied and investor loans, a first-home buyer is just a category of a variable loan or a fixed-rate loan. You just have a third category, which is first-home buyers, and then you would get a different pricing for a first-home buyer than you would for an upgrader or you would for an investor. It is not a complex decision for the bank to do. The systems could do it instantly. It would not take long to reprogram that, and very, very quickly. And it's in the bank's interest because the banks really are good corporate citizens these days. And I know that sounds a bit tacky, but going back through all the inquiries and royal commissions that we've had, they are trying to be good corporate citizens these days. And it's in their interest to do it. They all want to grow young customers because if you have a young customer and you lend them money, often you keep them for an extended period of time. They do refinance. But if you can keep them as a main financial institution customer, you can keep them for a long period of time, and building those good relationships is really important to the banks.
Thanks, Mr.